Now, for a look at how further support for Greece would impact European bond investors, joining us now is Christoph Rieger, Head of Fixed Income Strategy at Commerzbank. Christoph, good morning. Thanks for joining us.
Good morning.
Christoph, do you feel reassured from those comments from Jean-Claude Juncker that the EU will resolve the Greek problem by the end of June?
Yes, one thing is clear. The new deal for Greece, which we will get in June, will not involve any form of default or restructuring that could be labeled considered a default by the rating agencies. At least that is what the authorities are aiming for. However, looking at market pricing, the market seems to hear these words, but it's not listening, because if you look, for instance, at CDS spreads or short-end GGBs, there's still a default probability of some 20–30% at least discounted in these prices over the course of the next year already.
Christoph, why isn't the market listening then?
Well, I think it's a question of risk-reward, because the outcome, of course, is digital. Either we will get a new bailout, let's call it Bailout 2, or a tranquilizer for the markets, and then certainly this risk needs to be priced out. But in the more unlikely event that an accident can happen, and this probability is certainly not zero, then of course the consequences would be very severe, and risk-adverse investors need to price these risks, and this is why the market is currently trading the way it is. And it is difficult to, I mean, our baseline scenario also calls for Bailout 2 to be delivered, and then for spreads to retighten at least temporarily again, like we've seen time and again during this crisis, for the curve to flatten somewhat, the Bund curve that is. However, obviously the consequences of an accident would be so severe that it's very difficult to right now already position aggressively for this baseline scenario.
But Christoph, let's say there's no restructuring this month. That doesn't necessarily mean there won't be a restructuring, not even further down the line, but maybe in the medium term. So what are the implications of that?
Yes, clearly. This is why risk premia will remain elevated, and in particular intermediate to longer term GGBs will require an immense risk premium for the time being. A new deal is likely to carry a maturity of another 2 to 3 years, so I think 2013 is still a very key year ahead of the German elections, where the risks are very real that by that time the debt will then need to be restructured.
Lawrence Fink, Christoph, the chief executive of BlackRock, I mean, you heard the soundbite. He said, you know, we need to reorganize the continent's banking system. That's what's necessary. Are you in agreement with him?
Well, I would say certainly the Greek banking system. I think the international banking system would be hit by an earlier default of Greece. However, I think the main risk clearly lies in the Greek banking system, which would certainly collapse in this scenario, and where the Greek sovereign would not, of course, be able to bail out these banks. And then the more immediate risk that I see is really in the contagion into the other peripheral countries. And here I don't only mean Ireland and Portugal, which would most certainly be sucked down in this route, but also Spain and Italy, who fundamentally are on a completely different page. But as investors would retreat, they would very likely be facing a liquidity problem if we would get now an uncontrolled default event as early, say, as this summer, and then they would be not able to roll their billions of funding which they need to do every month. And then, of course, the consequence, as you can imagine, would be quite severe.
Christoph, thanks for joining us today. Christoph Rieger, their Head of Fixed Income Strategy at Commerzbank.